Understanding mortgages, a crucial skill for realtors. As a realtor, it's vital to have a solid grasp of mortgage basics to effectively guide your clients through the home buying process. However, it's important to note that this module is for your understanding only and not for providing direct mortgage advice to clients. The aim of this course is to equip you with the knowledge needed to address client questions and objections. Since each bank offers different mortgage solutions, it's not the realtor's role to provide lending advice. Always refer your clients to their bank or a mortgage broker for specific guidance. If your client requests a referral, it's a good practice to offer them your top 3 recommendations for bank representatives or mortgage brokers, allowing them to choose the best fit. There are 2 types of mortgages we will cover: high ratio and conventional mortgages. High ratio mortgages. These are for buyers making a down payment of less than 20%, often referred to as default insured mortgages. They are common among first-time home buyers and require default insurance, which comes with an additional cost. This cost can be paid up front or added to the mortgage balance, with most opting for the latter. Leading insurance providers include CMHC, Sagan, and Canada Guarantee, with premiums typically around 4%, depending on various factors such as mortgage type and property. For example, on a $400,000 purchase price with a 5% down payment, the mortgage amount would be $395,200 after adding the default insurance premium. Conventional mortgages. These apply to buyers with a down payment of 20% or more. In these cases, the bank generally does not require default insurance, but will almost always request an appraisal, which usually costs between $500 and $1,000, depending on the appraisal company, property, and market. With a lower loan-to-value ratio, clients may be offered a choice between a traditional, non-revolving mortgage, where payments reduce the principal without allowing further advances, or a partially or fully revolving mortgage, which offers more flexibility but may come with higher costs. Once the down payment has been determined, your client will need to choose the term and amortization period. Amortization period. The length of time over which the mortgage will be paid off, commonly 25 to 30 years. A longer amortization period results in lower monthly payments but higher overall interest costs. Term period. Length of time that the terms and conditions of the mortgage, including the interest rate, payment schedule, and other key aspects, are agreed upon between the borrower and the lender. Mortgage terms typically range from 6 months to 5 years, although longer and shorter terms are also available. During the term period, the borrower makes regular payments of principal and interest based on the terms set out in the mortgage agreement. At the end of the term period, the borrower must either pay off the remaining balance or renew the mortgage for a new term, potentially with new terms and conditions, such as a different interest rate. The length of the term can influence the stability of payments and the total interest paid over the life of the mortgage. It's important to distinguish the mortgage term from the amortization period, which is the total time it will take to pay off the entire mortgage if regular payments are made. The amortization is usually longer than the term. When choosing an interest rate within the term, there are several options. Your clients will need to select between an open or closed mortgage and decide on a variable or fixed interest rate. Open versus closed mortgage terms. Open term allow for extra payments or early repayment without penalty, while closed term have restrictions. Variable versus fixed interest rate. Variable interest rate can fluctuate based on market conditions, which can affect monthly payments. Fixed interest rate remains the same throughout the term of the mortgage, providing predictable payments. For example, some borrowers might opt for a 6-month variable open term if they are planning renovations and intend to sell the property in the near future. On the other hand, some borrowers may prefer a 5-year fixed closed term if they plan to keep the property for at least 5 years and want the security of consistent mortgage payments throughout that period. When the term ends, they'll have the chance to renew and choose a term that best fits their needs at that time.